Hello investors, my name is Stuart Cruz, founder of Cruz Asset Management. We're a boutique investment firm where we make our investing decisions based off of math and statistics. I'm also creator of our QVP process, which stands for Quantitative Value Portfolio. It's an investment process where we pick our stocks based off of a quantitative model that I created over 14 years ago. This strategy has outperformed the S&P 10 out of the last 14 years and added significant value to our clients net of our fees. And today, within our QVP model, we're going to talk about the retail sector. Because one of my clients, after getting one of those voting registration shares, noticed that she had a retail stock in her portfolio, Footlocker. She said, hey, why do we even own retail? Isn't retail dead? And that was the question. Why do we own this? And that's what the normal thought is on Wall Street, is that, or even on Main Street, is that retail sector is dead, that Amazon has come in and is going to take over the entire retail market, and that the only thing that is growing in retail is the online retail space, and more specifically, just Amazon. So I did the work to send her some information to show her why our quantitative models actually pick this stock up. And this is one of the reasons why we use quant models, so that our own biases don't get in the way of finding a good stock that might be out there. When we have our mindset that retail is dead, we just don't look at any retail stocks. But the computer doesn't have that mindset. The computer looks at the retail stocks, looks at all the stocks, and selects the best values from within those stocks. So in this particular case, Footlocker, I took a look at it. Well, what I wanted to do was look at the entire retail sector first to show her that that myth was actually not true. And what I found, according to this graph you'll see, is that the retail sector itself is growing at a reasonable rate, around 3.2%. So from the year 2000 to the year 2018, it's grown from the $250 billion a year sales to over $440 billion a year sales. So the growth rate certainly not lighting anybody's hair on fire, but it's still growing. And in fact, in absolute dollar volume, it is growing more than the online space. Now the online space is growing at a faster rate because it came from a lower number, a lower base. So in the year 2000, the online space was only about $2.7 billion. And now it's closer to $44 billion. But it's still less than 10% of the total retail sales category. So while it's growing faster at roughly 17% over that time period, and this past year, in 2018, it only grew at 7%. I'm not saying it's slowing down, but it is less than that long-term average. So while it's growing at a faster rate, it's still growing at smaller dollar volumes. The overall retail sector is growing much faster in absolute dollar terms. So there are more people going to brick and mortar stores than have ever gone before. There's more dollars being spent, and much more dollars being spent in person grabbing the items than online. And the same can be true for Footlocker. So Footlocker, when we looked at this, I looked back and we were buying this stock back in October of 2017, a long time ago. Again, retail was thought to have been dead at that time, and it was also thought to have been dead in 2008, when in fact, none of these things were true. So in 2017, we bought this October 16th, I believe, and since then, Footlocker stock has gone up over 92%, when the S&P has gone up 14%. Now, of course, not all of our stocks are winners like that. And in fact, we only have about 50% of our stocks winners, slightly more than 50%. But that is way better than the slightly less than 50% that most money managers have when they look for outperformance. So just having those odds slanted in your favor, very important. Okay, so that's the goal of having a quantitative approach, so that you see the stock, so you don't overlook a particular stock that's in a sector that just does not look or feel right to you, because the computer doesn't worry about the feelings. So that's our topic for today. Please, we're going to post this video. I want you to give me comments on to what you've liked about this video, any future topics that you might want to hear about, more about our process, or more about individual stocks. The reality is, we don't pick individual stocks based off of analyst reports or earnings estimates. We base them off of where the relative valuation is according to the computer models that have shown factors that have outperformed over long periods of time. Okay, so we can certainly talk about individual stocks like we did today, Footlocker, but I'm not going to give you an analyst report about how great their future is, because what we have found is analyst estimates and earnings predictions are no better than statistical noise. So in fact, they don't help you pick a good stock in the future. All right, so thanks so much for tuning in. In the meantime, like us on Facebook. Our Facebook page is on cruiseam.com. And we also can find me there, same place, on LinkedIn and Twitter. Also, be on the lookout for my new book that's going to be released in a few months called License to Steal: How to Turn Wall Street's Greed into Your Gain. And it's a discussion about the pitfalls of investing and how you can turn them into your advantage, and how, like we always want to do, slant the odds in your favor. So happy investing, and invest with the odds in your favor. Thanks so much. Hey there, thanks so much for watching our video. And because you made it all the way to the end, we're going to offer you a free portfolio evaluation. So click on the Riskalyze link below. That's a 7 to 12 questionnaire that will numerically evaluate the risk that you're willing to take on. And let's see if it's in alignment with your current portfolio. And if it's not, it's probably a conversation you need to be having with an advisor. Thanks again, and I look forward to seeing you in your next video.